We now know how to calculate beta. Here are a number of values that I collected from Yahoo Finance in the middle of August. And so you can see that Walmart had a beta of 0.32. It's a discount retailer. P&G, which makes consumer products, has a slightly higher beta. Merck Pharmaceuticals is at 0.49. Coca-Cola, Microsoft, 3M, Apple. Here's Amazon with a higher beta than Walmart. Here's Office Depot and US Steel. Office Depot, obviously, when businesses are expanding, they are buying more office furniture, and when they are not, when the economy is expanding and businesses are growing, they're buying more office furniture, and then US Steel. So what is it that determines beta? Not how do we calculate this number, but what is it that makes this beta larger than this beta? And the first important factor is going to be how cyclical the revenues are. Now, it's not the same as the volatility of revenues. So I can think about biotech versus steel. Biotech might be extremely volatile, but not very cyclical. And so I would see a much lower beta for biotech than I would for steel. And then, of course, steel versus soap. The next factor is going to be the operating leverage, and that's going to be the mix of fixed cost versus variable costs. And the operating leverage is extremely important because if I have an increase in revenue, but a lot of fixed costs, that's going to magnify the effect of the change in revenue on the change in EBITDA or earnings. And then finally, the financial leverage, the mix of debt and equity financing. Debt is essentially fixed financing. And so any level of fixed financing is going to, again, magnify the volatility of revenues on the net income or the earnings per share. And I have some examples of this that we'll do during lecture. Okay, so 3 main results of the capital asset pricing model. The first one we've already talked about, that the market risk premium is the risk premium of a stock is proportional to the market risk premium, and the proportionality coefficient is this beta. The second result is that this beta is actually equal to the correlation between the stock and the market and the relative volatilities of the stock and the market. This is important because I can see that if a stock is highly correlated with the market, but is not very volatile relative to the market, then I'm going to have a low beta. And if it's the case that the stock is very volatile relative to the market, but has a low correlation with the market, I'm still going to have a low beta. And so I might have a very high correlation, say Walmart, but low volatility, low beta, or I might have high volatility, but low correlation, so low beta, Merck Pharmaceuticals. The last main finding of the CAPM concerns this part of this initial equation. So we've just talked about what it is that determines this part, and that's going to be correlation and relative volatility. What is it that determines this part of my risk premium for a stock? And what we're going to find is that the risk premium for the market is going to be a function of the average risk aversion parameter for everyone in the market times the market volatility. So again, what I'm finding here for my main result is that the risk premium for a stock is proportional to the risk premium for the market. The proportionality coefficient is a function of correlation and relative volatilities. And the risk premium of the market is a function of overall expected market risk and risk aversion. And so the next thing we're going to do is we're going to sketch the derivations and implications of these 3 main results. We won't actually prove them or derive them. We'll just sketch these results.